Accounting is the identifying, the recording, and the communicating of data. That's basically what it is. It's recording business events, all right? Then you have to record those events to record the transaction. You have to put it into accounting language, and that's called transactions. And then you communicate the results of those reports or those transactions in the form of financial statements. Balance sheet, income statement, statement of equity, all financial information that tells people. I like to call accounting the profession of what happened. What happened? How'd we do? Did we make any money? Do we owe anybody any money? What's the story? What happened? And that's accounting. The transactions, the recording, the communicating of data. There's internal and external users of accounting. The external people are, well, how are businesses financed? People either buy stock, they go on Shark Tank and they get money from Mark Cuban, or they go to their banker and borrow money, or they go to a rich uncle and borrow money from him. But what do you have to do? You have to tell these people how you're doing so they know their investment is secure. Those are the external users of accounting. Lenders, shareholders, board of directors. Here's another external user, the government, tax returns, regulators, and naturally your customers. A lot of people don't do too much business anymore with Radio Shack. What happened to Radio Shack? It used to be you go anywhere and there'd be a Radio Shack around. Well, they aren't doing so well. Nobody knows what happened to them. So external users are very important. But for our class, a lot of it has to do with the internal users. A lot of you work for companies and you get monthly budget reports. Well, here's a heads up. Who does those? The accountant. So internal users, HR, marketing, production, distribution, they all get the information of accounting because they need also to know what happened. Opportunities in accounting, that's not worry about that. One of the key things about accounting, and if any of you have ever heard of the company Enron, you'll know what I'm talking about, Enron, is ethics. Are you recording business decisions and events ethically? Are you not, you ever hear the expression cooking the books? Oh, they must be cooking the books. They must be doing something unethical and saying one thing when actually something else is happening. The true profession of accounting is to make sure this does not happen. It happens though, but not always. That's why we have basically two types of accountants. We have an internal accountant and we have a public accountant, a CPA. The CPA checks the work of your private accountant internally. That's what a CPA does. I was a CPA for a few years back in New York State. Absolutely hated it, but be that as it may. And what did I do? I checked the records of other companies, making sure they did things ethically and legally correct. That's one of the main reasons for accounting, ethics. Fraud. Boy, I bet you every day in the newspaper, even up in Paso Robles, you see, well, Joe Schmo got it picked up last night. He embezzled $1,000 from his company. Joe, what'd you do that for? That's called fraud, embezzlement. Accountants usually find those people, make sure that things are done correctly. I mentioned earlier Enron. Enron was a company in Houston, Texas that basically lied to their investors and customers about their financial records. They lied to them. And they had the public accounting firm, Arthur Andersen, lie for them as well. What a bunch of knuckleheads. Mm-hmm. Guess where all those people are today?
Are they still in jail?
There's the Enron CEO just got released about 6 months ago.
What I thought.
But all the accountants are still in the hooch cow. They broke their sacred trust of being a CPA. The result of the Enron investigation and all the crooked, people lost their retirement savings.
Yeah.
It was awful. A law came out of that called Sarbanes-Oxley. And every public company in the country has to follow the rules of this law. Requires documentation and verification of internal accounting controls that nobody's getting ripped off. It's called SOX. Every company. I bet you go to the controller of the company you work for and say, hey, Miss Controller, you ever hear of SOX? You must have HASI in accounting. Because you are in week 1 and he's already talking about SOX. Keep on that guy. That's one guy you got to keep with. He's telling you the right way. So Sarbanes-Oxley is the law passed by the Congress to make sure we do things ethically in accounting. So what is accounting? Accounting, as I said, is the record keeping of business events. And the business can be a lemonade stand at the corner, or the business can be Amazon.com. The business can be the United States government, or the business can be the city of Lompoc. The business could be Martha and Ray hardware store, or the business could be General Electric. Everyone has to follow generally accepted accounting principles. It's called Gaap. They talk about that in chapter 1. So let's take a look at a short video that defines this mess we're going to be learning this summer.
What is accounting? Accounting is the language of business. Well, what is business? Well, you could say business is like somebody taking a hammer, building a house, and then taking his stuff that he made and selling it to somebody with money. Then they make their exchange and it's all good. Another way to look at business is that it is a magical box. You take raw materials, put it in the box, and then it comes out as goods that you can then sell and make money. That box is business. So let's say you have a business. You make something that costs you $100 to make and you sell it for $200. You have a profit of $100 and you're happy. I just told you a story about a business that made $100. So who should we tell our story to? You might want to tell your story to banks or investors. Banks or investors want to hear your story because they might want to lend you money or invest money in your business. Another person who wants to hear your story is Uncle Sam. He wants to tax you. We could break it down into 3 different people that want to hear your story. People on the inside, or internal users. People on the outside, external users, or the government. The language by which you tell these people stories is sometimes called managerial accounting for internal users, financial accounting for external users, and then tax accounting for government users. If you've ever taken an accounting class, it's usually going to be called managerial, financial, or tax. The actual language that external users want to hear your information in is Gaap, G-A-A-P, which stands for Generally Accepted Accounting Principles. The government wants to hear your story based on the Internal Revenue Code. That is the standard by which you must tell your story. Now, internal users, what's the name of the language that they want to hear? It's actually whatever you want. There is no standard managerial accounting language. If you're a business and you're talking to an external user, you want to look good or show that you made a high profit. Everyone wants to brag about how good their business is doing. However, when you talk to the government, your objective is to make it look like you made nothing. Because if you're rich, they'll take all your money. Now, if you're talking to an internal user, your objective isn't really to look good or to look like you made nothing. It's really just to tell it as accurately as you can, because that's the information upon which managers and decision makers will make decisions. Now, your story might be the exact same story in every instance, but depending on who your audience is, you're going to use a different language And each of these languages will actually tell a different story, even though it's based on the same actions of the business. In review, accounting is the language of business. Business is when you do stuff for profit. When you tell the story of your business, you're going to be telling it to one of a few different options. Internal users want to hear your story based on the language of managerial accounting. External users want to hear it based on Gaap, and the government wants to hear it based on the tax code. For more videos like this, visit account.
Next week. I bet you Professor Knucklehead from your last class never used a whiteboard, but whatever. Okay, I'm bad, I'm sorry. All right, accounting, all right? Accounting is this. One event, at least two transactions. One event, at least two transactions. For every event, at least two things happen, sometimes more than two, which that's how the language of accounting starts out with. Example, you just sent a check in to the University of Laverne for this summer term. So you sent them a check. So Laverne receives the check, and naturally that makes them smile. And at the same time, they take that check and deposit it into their checking account. At the same time, they also increase revenue. Two things occur. You sent your check in to Laverne and Shirley for the summer term. Laverne receives their check, your check in the mail or however you paid it, credit card, student loan, whatever, and they put that money into their bank account. But at the same time, they also have to record that they've received the tuition revenue from you. One event, two things have occurred. That's accounting. You as the accountant have to record that event in two different areas. All right? That's what makes this so much fun. For the first couple weeks, that's going to drive you friggin' nuts. Where does this go? What else is happening? That's what you have to figure out and learn over the next 2 to 3 weeks. Every event has at least two things happening. It's called this, double entry accounting. And here's an example. Accounting is separated into three main areas. Assets, liabilities. I'm also going to post this whiteboard to Blackboard after class. Pretty cool, huh? So you don't have to really worry about taking notes if you don't want to. I post this whiteboard after class. Damn. All right. Plus owner's equity. All accounting events revolve around those three main areas. What's an asset? Something you own. All right? An asset is your bank account. An asset is your building. An asset is your computer. An asset is your office supplies. An asset is your equipment, things that you own. What are liabilities? Things that you owe. Debt. I owe something. And it can be in the form of two areas, short-term or long-term. Short-term debt is this. My American Express card. Don't leave home without it. That's a liability. whenever like this afternoon, I charged a lunch on this card. I now owe the money. But the good thing about it is I don't have to pay it back for 30 days. Yeah, right? I don't have to pay it back for 30 days. It's a liability. It's called a short-term liability. All I have to do is pay that money back for that lunch in 30 days, all is well. But it also can become a long-term liability. If I don't pay that credit card balance after 30 days, what do they usually charge me? Interest, right? Interest. Then it becomes a long-term liability where interest is in addition to paying back the principal. It's called short-term and long-term liability. And then we have owner's equity. Now this gets really confusing because there's a couple of accounts in this owner's equity area. There's owner investment, when the owner puts their own money into the business. There's owner withdrawal, when the owner takes money out of the business. And there's revenue, when money comes into the business by you supplying goods and services. And there's expenses. You have expenses to produce that revenue. That's money leaving the business. So there we go. The art or the language of accounting is to put this business event. Laverne receives your check and deposits it into the checking account and increases revenue. Well, let's say this check was for $1,000. Here's the transaction. $1,000 would be an addition to assets. Let's put a plus there. And at the same time, $1,000 will be added to owner's equity in the form of revenue. There it is. That's accounting. And you're going to be doing transaction after transaction, especially next week, to practice this, understanding it. Look what happened. This is what gets sometimes students confused. Wait a minute, I received $1,000. Okay, I put it in my checking account. But now you have to say, all right, what was the $1,000 for? Oh, it was for tuition revenue. So I have to increase owner's equity. And next week, when we get into the actual recording of the transaction, this is called a debit, and this is called a credit. And you'll be reviewing that in the next week in chapters 2, but that's what that means. I'm debiting cash, I'm crediting revenue. I'm increasing assets, I'm increasing revenue. Wait a minute, Mr. Hassey, stop right there. You just said you're increasing assets and increasing revenue, but this is called a debit and this is called a credit, but you're still increasing it. Yes, I am, because why? The debit is an increase on this left-hand side of the equation, and a credit is the increase on the right-hand side of the accounting equation. Debit, credit. We'll be talking about this next week. But in the meantime, in chapter 1, get to understand what transactions involve assets, liabilities, and equity. And we're going to take a look at one in just a minute. Okay? That's all the definition you need for this week. An accounting event is at least 2 transactions. 2 things occur for one event. In the case of this example, cash is received and incurred. Equity is received and incurred. And I just saved this and it screwed up my margins, but that's okay. So just remember that. Need to remember that as we read forward. Now I'm going to open up this. Problem 1-2A. And it's talking about assets, liabilities, and equity for a variety of different companies. And remember, the company has to, the accounting equation always has to be in balance. Assets have to equals liabilities and equity. If there's anything you need to learn about tonight's class, so after class tonight, you're going to go, whew, so glad that's over. And your husband or your partner or your kids are going to come up to you and say, hey, how was class? All you have to do is say, assets equals liabilities plus equity. And they'll go, wow, you're cool. You know what's going on. And you'll say to yourself, but you won't admit it to them, I have no clue what's going on. That's just what Professor Hassey said. But that's okay. You're on your way to learn it. Well, here's a problem in chapter 1 that kind of shows you that. All right. Notice on, they give you companies, company A, B, C, D, and E. And they have certain blanks here. And you have to fill in the blanks. Okay. Now, for example, on December 31, all right, they have in company A, notice assets, liabilities, and company A has $58,000 in assets. But we don't know what the liabilities are. But during the year, we also know that these things happened on equity. Money coming in, $6,000, $8,500 coming in for a profit, net income, and $3,500 coming out. All right. Well, if you do that arithmetic, that's $14,500, $18,000. All right. Well, if I know that, excuse me, is that right? 18,000? Yeah, 18,000. All right. Well, I know that if my assets are 55,000, my liabilities are $24,500 in this year. That means my equity has got to be $30,500 for this to balance. In other words, assets plus minus equals liabilities plus equity. If I know my assets and I know my liabilities, the difference between the two must be $30,500. So I'm starting out this year with $30,500. I'm bringing in 6,000. That's 36,500. I'm bringing in 8,500, and I'm taking out 3,500. You do the arithmetic, you'll get $41,500. That's my equity or owner's position at the end of 2019. If that's $41,500, my liabilities have to be the difference between $58,000 and $41,500. So the answer is $16,500. What we're doing here is we're practicing the definition of determining assets, liabilities, and equity. It kind of gives you a feel of that. I want you to try to do that right here. See if you can do this one. Company B has $34,000 in 2018 of assets, $21,500 of equity, liabilities. What must be their equity position here? 30 assets must equal liabilities plus equity. So 34,000 has to equal 21,500 plus, well, it's the difference between 21,500 and 34. $12,500. So we're starting out $12,500 here in 2019. What must be our net income be for the year? Well, let me show you. Let me bring that up. file that I've posted in Blackboard that you can check out. But notice for company B, I have 12,005 equity at the end of 2018. Then in 2019, they tell me that I'm starting out the year with 12.5. I have owner investment coming in. I have withdrawals going out. That means our equity has got to be $13,500. In order for that all to work, income's got to be $1,600. Owner's equity is investment plus income plus withdrawals minus. We're backing into these numbers. I want you to practice this a little bit this week, just to get a feel for how assets, liabilities, and equity work. Balance and what makes up that. As I showed you in the whiteboard, owner's investment or equity is a combination of four things: investment, owner withdrawal, and revenue and expense. Well, the difference between revenue and expense has got to be either net income or net loss. That's what makes up the equity section of the balance sheet. Now, this makes a little bit more sense if you read the chapter, all right? So make sure you read the chapter, or if you don't have the textbook, just follow the PowerPoints, and that will help you understand that. I also want you to take a look at this problem here. A company has these following accounts at the end of December 2019. Cash, receivables, supplies, blah, blah, blah. These all are the accounts of all a bunch of accounting transactions during the course of the year. This problem wants you to put this into an income statement format. What would the income statement for this company look at? Now remember, the definition of the income statement is revenue and expenses. That's the income statement. Cash is an asset, that's balance sheet. Receivable is an asset, balance sheet. Supplies is an asset, balance sheet. Equipment, asset, balance sheet. Payable, liabilities, balance sheet. Capital, balance sheet. Withdrawals, balance sheet. Revenue, expense. The income statement for this company is a statement of revenues and expenses. That's it. You're telling the readers of this statement what were their profits for this year. Remember the PowerPoint slide we had a few minutes ago. Accounting is the recording of the transaction and then showing the results of those transactions into a financial statement. They give you the accounting here, and we're asked to put this into a financial statement, and that just revolves around those accounts. So here's what that financial statement looks like for this company. Aubrey, do you see this on the screen? This is a spreadsheet, and it's an Excel. You know, do you guys understand if you don't have spreadsheet or Excels on your computer, you can get them from the University of Laverne and download them for free. Did you know that?
Mm-hmm.
If you go into your portal and you can go into Microsoft Office and you can download a version of Microsoft Office to your computer because you're a University of Laverne student.
Perfect.
Right? Just so you know that. But Jessica, don't worry about that. All right, if you don't know how to do it or it freaks you out, we'll go over this in class, okay? So don't worry about it. But try it, just bring it up. I just brought this up. I went into my computer and brought up Excel, all right? Hold on, I have a chat question. Let me see here. Chat question says, Mr. Hassey, do you really understand what the hell you're talking about? No. Yes, what I'm going to do right now, Mr. Barlow, or Miss Barlow, who is this? Yes, Miss Barlow. I'm gonna do a sample spreadsheet right now, and I'm gonna save this to Blackboard so you can download it. How about that one? All because Jessica was very polite and asked. So first of all, I'm gonna expand this a little bit. There we go. All right. Here's one column, and we'll call it assets. Here's one column, and we call it liabilities. Just like I did on that whiteboard. And here's a column, I call it equity. All right? Transaction number 1. We'll use the example we used earlier. Oops. Transaction number 1. We receive a check for deposit into cash, $1,000. It's for tuition revenue. So we call this revenue, $1,000. All right? That's the first transaction. Notice I put it in these highlights here. Assets, make that official looking, liabilities, and equity. Then we have a second transaction. The second transaction is we need a computer for our business. So we borrow $500, excuse me, we use our credit card for $500 to buy a computer. So at the same time, we now have a computer. That's an asset. $500. At the same time, we now have what is called accounts payable. $500. All right? What's accounts payable? Credit card. We owe the money. We have to pay it back in 30 days. So notice what happens here now. I now have $1,500 of assets, and I now have $1,500 of liabilities and equity. It equals. Assets equals liabilities and equity. Transaction number 3. Jessica works for me. I'm going to give her her paycheck this week. I'm going to write her a paycheck for $200. Sorry, Jessica, I'm cheap. All right? So what happens? I write a check for Jessica. That's an asset, but I'm spending $200 minus $200. And at the same time, I now over here have wages. That's an expense. Let's make that expense. And we're going to call that wages. And I'm spending negative $200. Wow. I've now received cash for revenue. I've received a computer and borrowed the money. I now owe $500. And I've wrote Jessica a paycheck for $200, and I call it wages. Golly Gomer, $1,300? $1,300. Assets equals liabilities and equity. One last one, because this is so stimulating. I now pay the accounts payable balance. But I don't have $1,000. I don't have $500. I'm just going to pay partial. I'm going to pay $200. All right? So I'm going to write a check for $200. And I'm going to reduce my accounts payable because I've just paid off $200 of the balance minus $200. Okay, what do we got? Let's total this up. We have in assets $1,000, $1,500, $1,100. We have $300 of liabilities that we still owe, and we have $800 of revenue less expenses. $1,100? $1,100. We did it right. Now, Jessica, since I just gave you a paycheck, I want something in return for that money. What was this company's net income for this period of time? What was this company's net income for this period of time? Assets, these are all balance sheets accounts. They go into the balance sheet. But this is income statement, revenue minus expenses. Ladies and gentlemen, madame and messieurs, this is what we study these first 2 weeks of our class, right there. To record business events, but we're going to be doing it in the format of debits and credits, but we put it in the format where the accounting equation is always in balance.
Mm-hmm.
If I was cooking the books like Enron, I would say, oh, I took in $2,000 of revenue. But you go to the bank account and says, Enron only deposited $1,000. This is called cooking the books. Making sure you made more income and thus more profit, but they really didn't because the other side of the equation gives that away. You made $2,000. Where's the $2,000 here? You only got $1,000. That's the definition of cooking the books. All right. I will post this, Jessica. I'm going to save it right now. Let me save it.